Well, hello there. How are you? Welcome to Ensuring Your Well-Being. This is Dennis James, the Bike and Dance and Insurance Man. Glad you're here today. Anyhow, today we're going to be having a conversation in reference to personal life insurance and business life insurance. All right, the benefits of it and the value, which is what you really need to know. All right, a lot of people do not understand the value that it really brings, and especially to loved ones, or it could be a lot of the living benefits for family and also with your business. There's a lot of benefits when you have it set up for your business also. But I'm going to start with the personal life insurance and we're going to go from there. All right, first of all, life insurance it's going to provide capital, right, when you need it upon the death of the insured. All right, so if you're the wage earner, right, that's where you need to have life insurance in place, especially if you have a family. All right, where we're talking about personal life insurance. And what that does, it's going to give you upon a premature death, it gives you a guaranteed income. It's a stream of income like that, tax free, meaning you don't pay income taxes on it. All right, right. So the other thing with that, funeral expenses. All right, when something like that happens, it becomes very devastating to everyone, as family members. All right, so um, having that income to cover the expensive, right? So you got your funeral expenses, you have medical expenses, and a lot of times there's debt, and that could be credit cards or some kind of debt reduction. It could be to help pay for your mortgage or renters, or if you didn't plan properly, that could be probate costs. And depending where you're at with your lifestyle, it could even be estate taxes. All right, so very important to have in place, and you always get that because life insurance is rated off based off medical history, your driving record, what's your driving record like, do you have many points? All those things come into play for you. And weight, history, that type of thing, because of the medical underwriting. It's not like it used to be. It goes a lot quicker now. But at the same time, you don't need to hide anything because it's all in your records. And if you're older, a lot of times they're going to look at, hey, when does the last time you had a routine physical? A lot of they want to know that also. All right, and then we talk about non-working spouses. Okay, now think about that. Even though they don't have wages come in, the truth of the matter is, upon a premature death of a non-working spouse that is taking care of children, right? That is becomes just as critical as having life insurance. Think about it. Upon a premature death, what happens? All of a sudden, you have to start paying for taking them to school, right? With the that type of care. Okay, I haven't had kids. My kids are grown up and all that, right? But there's for sure a lot of the functions provided for the cost of care, and actually, to pay for child care and home housekeeping, and to get them back and forth, and all the different types of recreational that they're in. So that there's they say that a wage worker as a spouse, you could calculate that out to being $180,000 a year plus, by adding inflation in, because when you start looking at what it costs to take your kids, a lot of times I see that where parents are just staying home because instead of going out and getting employment, because it costs more just for the education behind it on that. So should they have life insurance in place? Absolutely, right? Just like we talk about child care. Should I have life insurance on my children? And that's never an easy subject, right? I mean, we can never see our own children passing away or dying, but we do know it happens, all right? And it doesn't matter what age. Accidents happen or come down with some type of medical terminal illness, and so that's why I have life insurance in place. And there's a lot of times what families will do is they will have a individual policy on the wage earner, and then on the spouse, you would have a insured spouse rider on there. And then you also, when we're talking about children, you would have children riders on there. Now, the thing when you do that on the insured rider for your spouse, a lot of times you can save money because of paying policy fees and all that other benefit. It just depends, right? Everybody's different about that. Just like if you're the insured and you may or not be married, right? You could add a child rider on there, and what that child rider will do, it will give you life insurance anywhere from, you could take $1,000 up to $15,000. And now let's just say you have 2 children, 3, 5 children. When you have that in place, that child rider, it covers, let's just say you have 5 children, it covers all 5 children. So let's just say you have $15,000. Upon the death of each one of them, there's $15,000 worth of life insurance in place. All right. Also, usually the way that works, all insurance carriers are a little different, but it's up to, you can have them on there up until age 18, where they can become part of your plan. Even though it will cover them to 23, they just can't say, if they're 20 years old, they can't just go to get on your insurance policy as that rider. All right. They have to do it before they're under 18. All right. But it'll cover them up to 23. And then let's just say at 23, they have to come off the plan. There's no longer life insurance under that rider. Well, they can get their own life insurance policy with that insurance carrier. And that insurance carrier, in most cases, the way it works is they'll give it 5 times the amount of insurance, right? So if you had, as an example, you had 10,000 covering each child, all children, times 5 is 50,000, right? So you're adding that up, or you could, if it was 15,000, right? What's that come to? 85,000. So all those added value benefits that you're receiving like that. And if that child becomes uninsurable and goes to get that permanent plan after they come off yours, it's a guarantee issue, right? So that your child could have, God forbid, but diabetes or cancer or MS, anything, and at least they're locked in for the 5 times amount, which really can make a big difference for them, especially if they're going to ever get married and that type of thing. And maybe they can't even get insurance, all right, depending on the, what's going on with their medical condition. And also, a lot of times people will just take out their own policy. So they'll get a life policy. Obviously, you want it for the wage earner. For sure, the spouse, and those could be individual policies. And sometimes people will take out their own personal life insurance, even for their kids. And the reason they'll do that for a lot of reasons. Some of the things I just discussed with you. Obviously, when you get the cost of insurance when you're really young, that's when you want to get it, when you're healthy, right? Because the cost of insurance is minimal. And it gives them something that they can own and that type of thing for their self in the future. I remember my mom and dad took out policies on me and my two brothers, right, when we were 18. I mean, we were young, and this Prudential guy, we sold us policies, and so we had some life insurance that when they were in our own name, and I eventually ended up using it for the cash value that was built up. I don't know. I had a couple $1,000 in there, and I was still really young, like 17 years old, and 18, whatever I was at that time, and I was able to convert that, or I could have kept the life insurance in place. Okay, so there's a lot of values of doing that. Now, when you want to calculate personal life insurance, things that you look at for needs is you want to look at existing assets. What's your current income, and that would be also future income. With your financial needs. Now, there's rules of thumb with this. All right. Now, if you're the wage earner, a lot of times what they'll look at, just so an idea for it, you want to have 6 to 8 times whatever your gross income is. All right, so right, pretty simple math. Have 100,000. That's what you're making. Well, you're going to want to have somewhere between $600,000 and $800,000. That's a rule of thumb. And then a lot of times they're going to look at different ways of calculating that out for you. All right. There's what they call the second thing would be like, your human life value concept. That's another way of doing it, or just a needs analysis. And what that's looking at, that's given a picture of what you're going to be your income today, what's your income for the future, where's inflation come into play, what's, with your mortgage, your rent, that type of thing, and it looks at a lot of different things, your income needs, projections. You become disabled or you become unemployed, all right, that always plays a factor. And all those things come into play. Then the thing about looking at also, right, you're married, and then all of a sudden, your husband passes away. He's the wage earner. Now, what happens is there's going to be benefits that come in under survivor benefits, all right, and that's going to cover your children up to age 18, all right, but after 18, that ends, all right, they call what they call a blackout period, all right, and then what also happens is as the spouse with your Social Security and all that, all right, that also, that blackout period ends, and it begins again at age 60. Okay, so those are things to consider when you talk to your insurance professional or your financial advisor. He's going to be able to do that, right? So he can give you a rule of thumb, like I mentioned, or he could get into the human value concept or the family needs analysis, which is normally the ones that are used the most today. But that's, again, going to depend on your whoever is working with you on your insurance and needs, your professional advisor. All right, so on the other side of the coin is business insurance, right? And that's for business owners, all right? When events are happening, without a plan, all right, it creates financial hardship, All right. We know that life insurance can be used for key person insurance, all right, funding buy-sell agreements, and they're also used for non-qualified plans, attract, retain key people, that type of thing, and we'll get into that a little bit. But when you're doing that, you're going to indemnify, never say that word right, indemnify your a financial loss, right? It's just like any life insurance, right? It becomes a tax-free benefit, and it's there when you need it the most. Now, business owners are going to take it out. A lot of times they take it out as key person insurance, and I really think that makes it really so important in a lot of different ways. But think about it, right? With key person, upon the death of a key employee, what's going to happen to your business, right? I mean, all of a sudden you have this person that's right bringing in all kinds of sales, and then all of a sudden he passes away. Who's going to you have to have, where's the money going to come from to replace him? All right. And what about getting, right, if you're going to pay for a recruit, right, to that, sometimes it's not that easy to do. But when you're doing that, they're going to want 15 to 25% of whatever on a commission basis to find somebody that's going to fit the need of that key employee. Now, we know that is easier said than done. The other thing a lot of times, that I didn't mention is creditors, right? So if you have credit and then all of a sudden they know your key person dies, and you know what, the truth of the matter, you could be that key person, all right? But we're talking about, people that are, without them, the business could go under, right? So there's a lot of things to consider when it comes to protecting yourself if that key person leaves the business, right? So I'm going to talk about how you can help attract, retain, and recruit, keep key people. And the other thing is buy-sell funding, all right, with life insurance, right? So you can have an agreement in place, but that's great, and it's important. You have to have an agreement in place, but without the funding, where is the money going to come from to buy out the other person or other employees, key people of the business that are partnerships, or they could be stockholders in the business, all right, or it could even be a sole proprietor. So that's where there's two different types that you could really look at that we're going to discuss here. And the first one is a cross-purchase plan, all right? And what that is where you're going to have a insurance policy. So let's just, for simplification, you have a business owner, right? Two owners in the policy. They're going to own a policy on each other based off whatever the value of that business is upon death to pay out to the survivors, and then to the deceased person that passes is going to pay off to the survivors, and then you would own that business free and clear, because you sure doesn't want you don't want to be partners with your deceased partner spouse, because that's what would happen. It can become really a lot of headaches and trouble. So when you have it all mapped out and you have the funding of the life insurance, right, it makes everything smooth, and that becomes a tax-free benefit. And also, the other thing is, if you have, as an example, 3 people, then all of a sudden you got to have 6 policies. Or if you had 4 people that are part of the ownership or stock in that, that's 12 policies. That becomes an awful lot of policies, right? Because each one of you are owners and beneficiaries on that particular insured, All right. So there's other ways of approaching that, and that's what they call the second type, and that's the entity plan. And the entity plan is where you got a business partnership or a corporation, and you agree to buy a insurance policy on whoever's the owners or stockholders are in there, right? So, as an example, if you have 6 people that are stockholders, major stockholders, and they have ownership in the business, or 6 partners, then that's where an entity would come into play. The business would be the one that pays the premium and is the owner on the policy of each one of you as the insureds. And upon death of one of you or 2 of you, let's just say one for simple, right? It's going to pay that percentage off, whatever that death benefit is, to the surviving partners. I'm sorry, the surviving, usually it's the spouse, loved ones. All right, so that makes it a lot smoother that way. And the other thing that businesses will do is they're going to use non-qualified plans. And when you hear non-qualified plans, that enables an employer to provide certain employees, like key employees, selective employees, to have a life insurance policy, a permanent life insurance policy, with a certain death benefit. It's going to accumulate cash value on a tax-deferred basis. It can have a lot of living benefits with a long-term care rider, which is so important to have long-term care insurance in place. And it could be where you put more money into it, just depending on the type of plan. So those types of plans are non-qualified. That means that you don't have to offer it to everybody within the business. So if you have 50 employees and you have 10 key people, right? That's ways you can offer, and you can offer different face amounts or percentages with each one of them, whatever you want to do. All right, so it keeps it real clean that way, and you can't get in trouble, just like if you had a qualified plan, like a 401k or a SEP, you can't do that. All right, so that's the benefits of non-qualified plans. And these type of arrangements, they're used to recruit, retain, reward employees, usually your top employees. And they have executive bonus plans, and those executive bonus plans work really well. And you can restrict it. That's where the employee is going to own it and that type of thing. And or you could have a restrictive employee business plan. And the way that works is you have more, as the employer, you have more control over it. All right. But the idea is to keep that employee and give them some added value. And then they have SERPs, or what they call supplemental executive retirement plans. And, that's just another way of setting it up. And that's where, your CPA and your advisor is going to figure out what's the best way to do that. And then they have what we call split dollar plans, and they're set up a couple different ways. You could go as an endorsement with it, or you could go collateral, right? And that's where it's between you and that employee, and you can have different split arrangements on it, and on paying the premium, and that way. So if you have, let's just say I'm a sole proprietor and I have somebody that I want to eventually take over my business that I feel would be the right person, we could have a collateral assignment where, I'm paying most of the premium as a business owner now, and the employee could be paying some of the the term, the cost of the term insurance, which is very inexpensive. and over time it gets to where he would be paying more of it, and I wouldn't as the employer. But these are ways of just being able to, offer to people that are really important within the business. And the other thing is the group carve out, right? So let's just say you have 50 employees and you're offering up, up to $50,000 worth of term insurance for each one of them. Right? I mean, it could be less, right? Anywhere from 10 to 50,000 without worrying about any kind of tax consequences. You could take whoever those key people is, and you could create a permanent plan with them. So that becomes a really nice feature there also. When you're doing any type of planning like this, it could be on your personal life insurance or your business life insurance. You're going to want to make sure you have an attorney that's going to they're going to put together the funding, the buy-sell agreement, right? Or when we're talking about personal, that's having at least the minimum is a will. And then, a trust is always good, important to also eventually get set up if you don't do it right away. And there's a lot of reasons for that, because you don't want to have issues and problems, financial dynamics going on or within the business, right, which creates hardship for everybody. So, you want to have a good estate planning attorney or elder law attorney when it comes to especially succession planning, depending. But for sure, estate planning, usually attorneys that are really know the business market on how to set up good buy-sell agreements. And when we talk about succession planning, really what you want to think of from when you're starting a business, it doesn't sound logical, but it really becomes real, is you almost want to start planning for the succession of the plan, over time, at least going in with that kind of a mindset, knowing that, hey, I'm starting this business and eventually there's going to be a succession of the business. And all this life insurance and funding I'm talking about, this is how you are able to keep the business moving smoothly, growing, and eventually, the business owners, as they go to sell out or buy out, you're going to, you need life insurance a lot of times for that's where you're going to want the funding on that. Life insurance is, you think of like pennies on the dollar, right? You give me $1 and I'm going to give you $10 back, or $100,000, right? Because you could take the policy out and pay $50 for a premium, just simplifying things here, and that gives you $100,000. You drop dead. Well, $100,000 is going to be that capital for either your loved ones or for your business. A lot of times, so really the people you need your insurance advisor, financial planner. They can a lot of times come together on that. A CPA comes into play, and for sure a good attorney. A lot of times they work together and they're connected, and they know how, they have the resources and the expertise to make sure everything is set up properly. So any questions, you could email me at vip@variousinsuranceplanning.com. I'm an independent insurance agent. I represent a lot of different insurance carriers in the life insurance, long-term care insurance, and annuities, right? So we know what each three of them do, right? You want to have everything set up always sooner than later, All right. And then you want to make sure you create agreements that go with it. And so I could be reached at 248 393 3146. You can contact me, or you can always schedule a time that is convenient for you. And anyhow, thank you for tuning in, and I want you to make it a great day. God bless.